Hey everybody, welcome back to another episode of Stage Debate with Cossack Isaac. Episode number 2 will be featuring a few multifamily experts as well as some awesome sponsors. Thank you. I'm Cossack Isaac. I help people just like you use their investment properties to offset their tax liabilities. Follow me on LinkedIn, tune in, and enjoy the show. Welcome, everybody, to episode number 2 of Stage Debate. Stage Debate was a vision that was in the works for a long time. Panel style discussions about real estate, different asset classes. Now we're focused on multifamily. Today we are joined by three big guys in the space, friends of mine. Sridhar, we've done a lot of work together, and it's been a nice journey. Shane, I got to know recently. Joel Fine is the founder of Lakeline Properties. He's GP'd in over 1,000 doors, LP'd in over 18,000 doors. He's a very smart man behind the scenes, pulling a lot of strings. It's an honor to call you a friend, and thank you so much for coming on. Shane Carter is the CEO of Hampshire Capital. He develops, he buys, he's bought over $315 million worth of existing multifamily real estate, and he's developed over $120 million worth. And he continues to impress. He just closed on a beautiful deal in Dallas, as well as a deal in San Antonio, in partnership with other big investment firms. And it's incredible to see what he does. Sridhar doesn't stop, just continues to impress. He's GP'd on over 3,700 units. He's developing 636 units right now. He's invested in other syndications. He's worked in the Fortune 500 companies for I don't know how many years, 20 years, and definitely some big brains behind that. Super, super impressive, and thank you guys for coming on. This all cannot happen and would not happen and could not happen without our sponsors. Our corporate sponsor is Michael Stern of Line Star Tax and LSD Consultants, a real estate tax genius. Really knows the ins and outs, and he's a tax advisor as well as a CPA. To all the listeners, somebody definitely to get in touch with. Our episode sponsor is Elite Roofing, which is owned by Rafi Levy and Sammy Cooper. They are nationwide commercial roofers. They've done huge projects, will be prices, and they're just exceptional people to work with. So I appreciate the episode sponsorship. Let's talk about something that is cliche to a certain extent. Everybody's talking about it, but it's always nice to have fresh minds come in and say their take and give their take about what's holding us down. As Joel said, he's laying low because things are crazy out there. It's wild. It's wild out there. And curious to hear your guys' thoughts on it. Interest rates, obviously, being where they are, as well as insurance rates. And technically, they're two different topics, but at the same time, as a syndicator, it's something that you both have to navigate when you're looking at a deal and underwriting a deal. Those are two big factors that could change the landscape of a deal, as well as your equity guys. They're not going to want to come in with you if the price per door is too much and it doesn't make sense. You got to pencil it out somehow. We're going to start with Joel. You've done a lot in the space. You've been in the space for a very long time. You've done a lot of successful syndications, and you did mention to me earlier that you are laying a little low. What's your take on syndicators going full force and continue to do that? Why do you have a different approach? And how do you see the future playing out in the next couple months and towards quarter two, quarter three, and obviously towards the end of the year?
Yeah, so I guess I would start. Well, thanks for having us on on your podcast, Isaac. Um, as you mentioned, the change in interest rates over the past couple of years has just had a really profound effect on the industry and the market, and on capital raising itself. And not just the change in interest rates, but the rapidity with which they changed. It was just a really abrupt adjustment from the Fed in response to increasing inflation that took interest rates from near zero up to something substantially higher. So that's really had a deep and probably lasting impact on the space. Everybody's looking at deals differently. They're underwriting their numbers differently. Capital availability is sharply reduced. There's a lot of folks like me who are in deals that we anticipated would go full cycle by now and we'd have capital freed up for the next thing. And instead, people are hunkering down and holding deals longer than they expected to, and that's had a big effect. Kind of like it's a reverberation through the system where people who would like to do the next deal are struggling to raise the capital. People I talk to, they maybe they can raise 5 million in a typical deal 2 years ago. Now they're lucky to raise 1 to 2 million, and so that's just, again, it's been a shock to the system, and it's affected, I think, everybody's deal making ability. The other thing is, with the change in interest rates, the kinds of deals that appeal to people are very different. For example, I'm seeing a lot more interest in deals with assumable loans, because obviously an assumable loan that was made at a fixed rate before the interest rate spike has a really different underwriting characteristic than something that's got to get debt at current rates, or is it floating and is now at current rates. So different kinds of deals appeal to people. And so that's affected my strategy as well. As you mentioned, I'm laying low. I've shifted my strategy over the last couple of years. I'm focused a little bit more on development than on value add multifamily. To me, there's a little bit more opportunity there, a little bit more green field that I can get creative with. But in general, I like you said, I'm laying low. I'm doing fewer deals and being really, really picky about the ones that I do.
I appreciate that. And one of the reasons why I brought specifically you three together is because I do know that you're working a little bit on development. Sridhar is working on development, and Shane is also has that development play in his arsenal. Development obviously is a whole different animal than traditional multifamily value add. I have seen that interest rates could be harder to get good terms on development than there is on a multifamily. I wanted to ask you, Shane, in regards to what Joel had said, is there any specific opportunity now more than before due to higher interest rates and higher insurance rates, as well as what's your take on floating debt versus fixed debt? People are obsessed with fixed debt because obviously you're safer. Floating debt is scary, and a lot of people in the COVID era took floating debt and they really got pretty messed up when interest rates went up. Is there an opportunity as well as floating versus fixed?
Yeah, great stuff. So Isaac, again, first, thanks for having me on. Really appreciate it. Always good to see you, and great to meet you, Joel and Sridhar. Looking forward to meeting you, learning more about what you're doing. But to speak directly to Isaac, what you're talking about. Look, my view personally is that there's always opportunity. If nothing other than what this last interest rate environment has taught us, is you have to be flexible. You have to be able to work with the market that you're in, and you have to be able to read the tea leaves, so to speak, to understand where the opportunity is. Where we're seeing the opportunity and where we've recently transacted, look, like Joel said, it would be fantastic if we could find fixed rate debt at 3.4% interest that we could assume that's at a 50 to 60% LTV on the existing asset. I would opt for that all day long. It's just not easy to find, and there's not a lot of it out there. And a lot of it doesn't have that sort of tail on it. So what we're able to do is instead work with what we have. Good pluses and minuses of fixed rate and variable rate debt right now. The fixed rate debt that we're placing, what we're able to do for buying that asset in Dallas last year is we're able to say, well, look, the Treasury is where it is. The fixed rate debt from Freddie and Fannie that we can get is here. We need a 1.25 debt coverage ratio. So based on what you guys have, here's what we can pay for it. And so what we're able to do in this time where the opportunity is, if you're looking at life or if you're looking at the business this way, is we're stepping into assets at an amazing basis compared to not only what you could get 2 years ago, but what you could even get 5 years ago. And we're utilizing the current interest rate environment as the reason that we have to transact at those levels. Now, again, those are a bit of a needle in a haystack as well. You don't have a ton of sellers that just say, oh, okay, fine. You can buy my asset for a fantastic basis because interest rates are high. Sure, I'm happy to trade with you now. There's not a lot of that out there either, right? So it's a bit of a needle in the haystack either way. But for sellers that need to sell, the end of a fund, the end of their hold period, and they bought it at an amazing basis, 8, 10, 12 years ago, and they're long-term holders, there's an opportunity to utilize this current interest rate environment to your favor by achieving a fantastic basis.
I love that. Yeah, keep going. Go
Yeah,
for it.
on the variable rate side, my partner Nick and I discuss this and debate this all the time. Should we go with a Freddie floater? Should we go with a fixed rate product? What are the pluses and minuses? Do we go with a bridge debt product and buy a cap rate that's in the money? And what are the pluses and minuses of doing that? And for where we sit right now, what we're doing is just ensuring that we have appropriate levels of debt, first of all. And what I mean by that is the bridge debt is really going to allow you to have a higher leverage point. And if you need that, because it is harder to raise equity right now and the deal supports it, so to speak, I can see why people are choosing that. We're not in that camp, though. We are not choosing that. We are sticking with the safe bet. We are sticking with that 50, 55, 60% tops LTV and fixed rate, where we can essentially guarantee what exactly our business plan will be because we have that fixed rate product. So everyone believes the Fed's going to continue to drop rates, interest rates will come down. Everybody believes that, right? But when you're signing up for and taking an investor's money and you're talking about a business plan that's 5 years hence, we feel like it's safer and more prudent to just go with the fixed rate debt at this time.
That's the right answer. That's the right answer every single day. Fixed debt. That's what most people are going to say. I technically agree with you. My question is that everybody has their exit strategy, and everybody has your fixed rate for 5 to 7 years, whatever it is. Let's say you have to sell prematurely. There's going to be problems unless, I guess I could preempt the answer, is that you hope not to do that. And if you do that, the penalties, the prepayment penalties, you'll have to stomach versus taking a bridge and suffering that way. I guess it's the worst of the two evils, and you'll pick that. Does that make sense?
Yeah, no, it does. You're 100% right. And that's why we take the debt that is appropriate for the business plan, and it usually has a 311 or some type of step down where those exits, we're not getting hurt in terms of exiting maybe slightly sooner than we would have.
Absolutely. Sridhar, again, appreciate you being on the show. So I was a bit involved in a recent transaction that you did, that you were under contract. If you don't mind talking about it, putting you on the spot over here. A recent transaction that you closed on, that you were under contract on for a long time. And a big part of the reason why it was stalled was because of insurance, if I'm correct. Correct?
Yes, insurance is one of them. Yeah.
Can you talk a little bit about that, a little bit about your hurdle and what you did to get over the hump?
Sure. Thanks for having me on the show, and nice to meet Joel and Shane on the show. Yes, we had so many challenges in that transaction, and I learned a lot. Even though I've been doing so many transactions, still I learned a lot. Initially, we were going for a Fannie new loan, and then Fannie said that the property has a deferred maintenance, so I have to take the assumption rather than a new loan. So we had to switch to the assumption, so that killed a couple of months. Once we are ready to close it, and then we reached out to the insurance and we had some quote. And just 24 hours before the close, they said that the insurance said we are stopping all the policies in Houston
Wow.
market. So, I mean, seller understood the pain, and then he said, okay, go ahead and shop around. So we have the same problem with the existing ones also. Everywhere the insurance cost went up. We kind of, at that point, we were thinking whether we should proceed or we should completely give up the EMD and walk out. So it pretty much doubled, insurance pretty much doubled. So we went to the seller and said, hey, the numbers are not working out, so help us out. So we end up negotiating the price down by $1 million. And then also we got some money for the deferred maintenance. So that's how we were able to make the numbers work. And that is an interim policy, so we are working on reducing that further. It's a group policy. We got it at moderate rate. It's not very cheap, it's not very expensive. So we went to a group policy. Now we are working on our own master policy to reduce it further. So eventually, our goal is within the next 6 to 9 months, we want to be where the rates were previously before we started the transaction. It's a journey that we have to embark on due to several reasons. So many hiccups, so many dynamics in the market that we did not anticipate. So we are learning through the process. We are evaluating step by step and then taking further on that. So because of the deferred maintenance and all, Fannie made us escrow $5 million. You won't believe. So that's another shocker. So in the transaction, so we ended up doing that too. Yeah.
I love it. Listen, I was so happy that you got that done, and I guess that's what separates the men and the boys. The big boys, they know how to pivot. When I was watching the Super Bowl, so obviously, I don't know if you guys are football fans, but the idea is that Patrick Mahomes he wasn't having a good game. But everybody knew that he'll get it done the same way Brady got it done every time. So even when he was in the hall. So Sridhar, you've done a lot of good stuff and a lot of big syndications, and you weren't going to let this just fly out the window. Joel, I have a question for you. So we talked about laying low a little bit. Everybody knows if they check you up, and I remember when you were super active on LinkedIn, you were closing deals. I don't know how often it was, every other month, every third month. You were doing a lot, and you have that name for a reason. I have a question. There's an argument to be made that, and it's something I brought up to Shane earlier about potentially there's an opportunity um, today more than there was when the market was hot a few years ago. And people say it by residential houses as well. People going to buy their primer house. I don't know. I shouldn't buy because interest rates are up and my monthly payments are too much. But there's an argument to be made that the sellers come down much more and they're much more negotiable because it's not a hot market and things equal out. You hope to be able to refi when rates come down. That's the traditional regular argument. You know the market better than a lot of people. Um, what continues to, I guess, worry you about that? Um, and you've touched on it before, but I would want to hear again a little bit what worries you to go into something and then hoping to be able to refi at a lower rate. And obviously, it's something I want to talk about soon also, and rearranging your capital stack, and people are doing that and restructuring it different ways. To be blunt, why don't you believe in that?
Well, so I guess there's a few things that are on my mind. At a macro level, I see the capital markets just really being much more challenging than they have been over the past 5 years, at least in part because of the interest rate environment, but also, like I said, because a lot of deals are not going full cycle. A lot of folks are kind of stuck. They've got their capital in deals that they thought would free up by now, but have not. At an even higher macro level, uh, we're looking in the U.S. at that mountain of debt that shows no signs of slowing up. And so, even though the Fed is saying all the right things and talking about reducing interest rates over time, at the same time, the federal government is borrowing so much money that there's a lot of uncertainty about what's the economy going to look like in the next 3 to 5 years. Is the Fed really going to have the flexibility to make the moves that we all would like them to make? There's also uncertainty related to the political environment with the election coming up in, what is it, 6 or 8 months now. And that's just a fundamental fact of life. Every 4 years, we're going to be faced with this kind of uncertainty when we're not quite sure what the policies of either the current administration continuing or the next administration coming in will be, and how that'll affect all of these macro environmental factors. Then at a more local level, I'm looking at things like to what extent is Austin, where I operate, either fully built or overbuilt. The supply pipeline is very full. There's a lot of new units that either have recently come on the market or are about to come on the market, especially relative to the growth of the population. So long term, I'm very bullish about the location I'm in Texas, overall, and Austin in particular. I think it's going to continue to thrive and grow. It's a business friendly environment. For the most part, it's landlord friendly. And so I'm happy to be here. But at the same time, in the short term, we've got to deal with these competing factors that if the supply pipeline is very full, and that's the perception of folks who supply the capital, either on the debt or the equity side, again, it just makes it harder to get deals done.
Understood, and that makes a lot of sense. And I'll just end off with you with a question like this: deals that you are in mid-cycle, if you are, do you have deals like that? How are you managing that and navigating with that?
Yeah, the deals that I'm in, especially on the value add multifamily side, they're all just treading water. We underwrote them at a particular expectation of how our floating rate debt would behave. Those expectations clearly were not met. Our debt is way more expensive than we had anticipated, and so essentially all of our NOI, all of our operating cash flow is going into servicing the debt, and so we're just hunkering down, trying to survive this period, hoping that at some point the Fed will be able to reduce rates without spiking inflation again, at which time, we'll have some cash flow freed up that we can either, distribute to our investors to pay them back for their patience, or to potentially sell deals and get into new things.
I get it. It makes a lot of sense. Makes a lot of sense. Shane, question for you. In terms of the capital stack, obviously you have senior debt, you have mezz, you have pref equity, and then you have the regular LP investors. Have you at all seen a restructuring of that based on today's market? And do you believe that there are, I guess, certain percentages of that have to change in order to be more favorable potentially to LP investors to make up for what's going on?
I think how you structure a deal on the cap stack is has always been important. It's always one of the top ways you're really sorting out how you're getting into a deal is really setting the stage for yourself in the end. And I think like with the debt stack, how you solve your equity. Pref equity is prevalent, right? All JV equity firms are currently putting out pref. Pref is a great place to sit in the stack from relative to a last dollar exposure, and there's a lot of money out there that wants to sit in the pref position. Look, my money included, right? It's a safe place to be. It's a decent place to sit in the stack. But for sponsors, I would say, look, you got to be careful with how you use that and how you leverage that. Yes, if it's done right and you execute the business plan right, and you're conservative on all your on all your aspirations in your business plan, properly utilized pref equity can enhance returns to LPs, but it can also chew up all the profits, right? If you don't use it right, if you overuse it, if you over leverage it, you're sort of placing an inordinate amount of risk upon your LPs by putting that pref equity too high in the stack. So I think at appropriate levels, it makes sense. Otherwise, I feel like most LPs don't want to sit behind pref if they're savvy, astute. Certainly, institutional grade won't do it. And then you're relying upon a smaller pool of syndicated capital that will sit behind it.
It's very, very interesting what you're saying. And I see so many young investors, their motto is get the highest LTV possible. And sometimes that makes a lot of sense. And sometimes being over leveraged is detrimental to the deal. And you said it so well. Sometimes having the right amount and the right structure of pref equity could actually boost the situation for the LP investors. So having somebody who knows what they're doing, and again, this really separates the people who know what they're doing and been in the field and have that reputation versus the younger guys. And I'm a big fan of the younger guys. There's always a next generation, but the idea is knowing how to structure that properly is super important for the success of a deal. People, they come in trying to bat for the grand slam. Let me get 90% LTV, which obviously is impossible in today's market, but let me get the highest possible. Sometimes it might not make sense.
Yeah. And hey, Isaac, I want to go back to something Joel said before, if it's okay.
Sure, of course.
Because I agree with him that now look, we have a national debt problem, right? But I also believe that this sort of higher for longer narrative and this elevated interest rate environment is is there to help erode that national debt problem. And the more that we have this higher interest rate, the more erosion of that national debt occurs, right? And so I personally believe that we're not going to see a precipitous drop in interest rates. I think we're going to be hanging where we are for the next couple of years, and it's going to maybe slowly dip down. But I would also say that in addition to the election year issues we also have major geopolitical issues, right? And all of this is creating an environment of fear, which is creating, when people are fearful, they just do nothing, or they go into the fetal position and recurl and sort of circle the wagons and make sure everything's safe. Nothing wrong with that, but that's what everyone's doing, right? And that's why there isn't a lot of capital out there right now. There's a ton sitting on the sidelines, but it's not being deployed due to a lot of fear. And so if we were to take a look at it from the perspective of, be greedy when others are fearful and fearful when others are greedy, well, what time are we in right now? And we are looking at a lot of opportunistic plays relative to the development that Joel discussed, completely overbuilt and the pipeline's massive. But I think there's a great opportunity to pick up extremely well located real estate at a basis that is amazing given the interest rate environment and times that we're in. And I think when we look up in 3 to 5 years from now, people are going to say, oh man, I wish I bought in 24. I wish I bought in 23. I wish I picked up that asset at that steep discount that I could have gotten at in 24 when everyone else was sitting on the sidelines. So just my 2 cents on that.
I totally hear that, and everybody knows the saying, hindsight is 2020, and you got to trust your gut and a little more. You got to push yourself a little if it makes sense. Something I wanted to ask all you guys towards as we end toward the last part of the show. You guys are all in some sort of way involved in development, and I wanted to ask each and every one of you, and we'll start with Sridhar. What do you see in development that attracts you more than the traditional classic multifamily value add that you're so used to, and going into a whole new sector of development and dealing with obviously city laws and state laws and all the red tape. And obviously it's harder to get investors on development because it's not cash flowing day one like multifamily value add. They have to see the long term. They have to see the long play. What talks to you about development for each and every one of you, Sridhar? If you could fill us in first.
Sure. So value add, as Joel and Shane were mentioning, the lending environment is not friendly. The interest rates are so high. On top of that, taxes are going up, irrespective of the timing of the market. They are not cooling off. The taxes are going up, and delinquencies are going high because of the economic environment, right? So after seeing all that, the cash available for distributions have gone down significantly. Even for the properties that have fixed in interest rate debts, it is challenging to get the same level of cash flow than what we used to have like a couple of years back or even a year plus back. With that said, we looked at the deals, and the pricing wise, it did not adjust that much in the market. We thought that we should look for a better alternative for this one, and then initially we were a little hesitant whether we should go into development or not. But what we saw is in Texas, yes, there could be red tapeism and all that, but despite all that, it is easy to get the permit in Texas and start construction in Texas. And one more big challenge is we don't need to manage the deal day to day to do the distributions. Unlike in value add, you have to constantly look for the optimization of all your expenses and smooth cash flow to do the distributions. In here, you don't need to worry about that. If we are funded properly, and if we have a proper risk mitigation in the development deal, I think it is as good as any other existing multifamily without having to do the distributions every quarter. And as long as we have a strong team to deliver, like a GC, and then the project managers, the construction managers, overseeing the progress and making sure that we are on budget and within the timeline I think it is doable. More and more projects are more profitable, even in the high interest rate environments, because the cycles are shorter. Um, the margin for error is there, but as long as we mitigate the risk through proper mechanisms, um, I think development deals do work in the current environment. Only thing we need to be a little cautious is we should not get into a very hot area and to oversupply situation. Then it would be difficult to fill in the units once we complete the project, and that may lead to a different challenge in refinancing situation or lease up refinancing situation. Um, in general, Dallas and or in general in Texas, all cities are growing. Even in the current market, people are migrating still, and the organic growth is there, and they are slated to grow further. So I don't see a big threat in Texas markets as long as we have a proper project management mechanism for the development projects.
Very interesting. Joel, I know you touched on it earlier. What interests you about development more than multifamily?
Yeah, so for me, it's all about a couple of things. One is the value that I can add, and the other is the degrees of freedom. So let me start first with the value I can add. So if I can sort of twist the phrase, we talk about value add multifamily, where you take an existing asset and you improve it in some way. Maybe you renovate the property, you replace the property management, you improve the tenants. The the degree to which you're improving the property is relatively small compared with the value that you begin with. You might start with an apartment complex that's worth 10 million bucks, and you make it worth 12 million by improving it in various ways. So the incremental improvement is relatively modest. Whereas if you take a piece of bare dirt and you figure out a way to put something on it that becomes a cash flowing asset, you can 2, 3, 5, 10x the value of that dirt. And so there's just tremendous opportunity there. Now, obviously, that comes with risk, because as you're going through the project, the nature of development, the kinds of outcomes that can happen are going to vary a lot more. If you discover, for example, that the zoning doesn't work, or the demographics of the area don't match your planned use of the property, you could have a real problem on your hands. But if you can align all of those parameters, all those constraints, you can really add just a tremendous amount of value to a relatively small, investment. So the leverage opportunity for me is really strong there.
As,
The
as a
other, the
great,
other thing is the degrees of
yeah, go
freedom.
for it.
Like I said, that, if you start with a piece of bare dirt, there's a lot of different things you can do with that. Uh, all kinds of asset classes you can bring to bear, whether it's multifamily or something else, office, retail, storage, et cetera. And you can pivot over time. You can discover, hey, it turns out this piece of property isn't really suitable for multifamily for whatever reason. Let's change the business plan and go at it a different way. You can change densities. You can change the degree to which you're, the class of improvement you're putting on the property, and so that, I think, creates opportunities for a lot of creativity that you may not find in just traditional value add multifamily. So again, the potential for improvements come with risk. There's always a consistency in the risk reward trade-offs you're dealing with. But those are some of the things I look at when I get excited about development, is the value add opportunity and the degrees of freedom.
Super, super interesting. Basically, when somebody buys a multifamily value add opportunity, and not to diss it at all, obviously there's a there's a big play on that, but you're capped at a certain extent. And I've heard this line before many times. Developers love development because they create their own cap rate. The way you structure it, you're creating your own cap rate. You're not really locked into a certain structure. Shane, what's your take on development? And obviously, you're really doing both. You're super active on multifamily, existing multifamily, but you're involved in development as well.
Yeah, look, mine comes from more of, that's just where I come from. I came from development. I made my money. I was a general contractor for 20 years, so I came to invest. I always invested in multifamily while I was doing that, but I've had that as a cash flow business for decades now, and I've just morphed it into being more of on the land side. So ours is twofold. We focus on the land. We take the raw land, we get it fully entitled, and we sell it off. So right now we're focused on single family homes, townhomes, publicly traded top 10 businesses, D.R. Horton, Lennar, Centex, Taylor Morrison's, et cetera, selling into those groups. And that's really our business model for our land development core of the business. On the multifamily development side, however, again, because of this overdevelopment that is happening right now, and it's being delivered into a high interest rate environment, we are being extremely opportunistic. We just found another deal this week where the developer fell down. They fell down flat, and they're close to the finish line. They're 75, 80% somewhere, depending in there. We'll find out in due diligence, close to getting that CO, but they've just failed, and so things are falling apart on them. And we're looking to swoop in, take care of that, finish off the construction, do the lease up, get the stabilized asset, and be into that for an amazing basis, almost like below replacement cost basis at this point. And so, we're being opportunistic given that the market has these types of events that are happening. There's merchant builders out there that were going gangbusters. All of a sudden, the interest rates just flew through the roof at a rate that no one has ever seen ever before. And they're stuck between a rock and a hard place. So they've got 4 or 5 of these going at once. And maybe one is in an amazing neighborhood in Dallas, and one's in a prime, northern section of Houston. But then they have these other ones, and they're like, gosh, I can't make sense of these anymore. I've got to just ship them. We got the CO. We need to just sell these now. We're at 15% pre-leased, and I can't deal with it anymore. I got to get it off my books. That's a prime opportunity to swoop in, have a very conservative business plan for what that lease up is, and again, get into an asset at an amazing basis given the climate we're in. So that's what we're looking for on the development side in terms of opportunistic.
No, I love it. And obviously, somebody who has a background in construction, it's almost putting your abilities to waste if you don't utilize that, and you really know the ins and outs. So that's cool. Okay, so wrapping this part of the show up, we're going to end off. I appreciate your guys' insights. Unbelievable. I definitely gained as well. Wrapping up the show, I want to talk about, for maybe 2 minutes, a guy over here, an aha moment in your career that could have boosted you and given you the self-confidence or to move forward, something that has happened. It doesn't have to be anything grandiose. And a piece of advice that you would give to a newbie investor. Like we said, there's always the next generation.
So I'll do it in reverse because I get asked this question a lot, and it's always the same answer because based on my experience, the number one thing I would tell someone young and coming into this business is don't get too distracted. Don't get shiny object syndrome. Pick a tract that you are passionate about and go deep, not wide. Go 100% into it. Become an expert at it. Get your reps in. The kind of classic Bruce Lee quote, which is that I do not fear a man who can kick 1,000 kicks or 10,000 kicks. I fear the man who can have one kick that he has done 10,000 times, right? And so really get hyper-focused and don't get shiny object syndrome. That's my best word of advice to young folks getting in the business. And then aha moment, for me, one of my biggest aha moments was when I realized that I was thinking too small. And I had somebody help me realize that because, I was doing my thing and making plenty of money and I was happy and everything was good and I was achieving my written life goals. But somebody said to me, hey, Shane, have you considered that you're thinking too small? Have you considered that instead of, doing a 20-lot subdivision, you could be developing 200-unit multifamily complexes, or you could be, buying 2,000 units in Texas and stop, thinking about, what you're doing up there in New England and in New Hampshire. And that was my aha moment, that the skill set that I had and the way I was executing is completely applicable to just a larger scale. And I was just thinking and playing too small. And so that was a big aha moment for me.
It's great points. One of the guests that we had on the show last week, his name is Garrett Lynch. He owns a bunch of stuff, and he talked about this. He talked about young guys going after the low hanging fruit, and that's what I understood. What you said about the shiny objects. Don't just grab the low hanging fruits that seem very enticing. Go into the good ones. Go into the hard deals. If the deal pencils, you'll get the capital. Don't worry. Don't just go for the easy ones. Sridhar, an aha moment in your career. You've been in the space and on Wall Street, I believe, for like, I don't know, forever. So and a piece of advice that you'd give to a newbie investor.
Sure. So when I was planning to do this real estate thing, initially I was focusing on single families and tried for 1.5 years, could not buy anything. I kept on telling this story in every podcast, right? So and then it so happened into this one, and I had a moment saying that, hey, I've been spending so much time and nothing is working out. Should I go big or should I go small? So at that point, I decided let me take a risk, so and go for bigger items, and then in that process started looking at all the commercial real estate, whichever works on. But I was not sure whether I would be, I mean, able to even buy one single property because I have no clue that how much money is needed to close a deal and all that. Um, so we partnered, and then we got this 96 unit. The first raise was $1.2 million. So when I started talking to people, I was not sure whether I would be able to raise any money. But my plan B was like, in worst case, I will sell all my stock and put my share. So that was my plan B. Once I started talking to people and I started explaining it, and to my surprise, a lot of my friends joined me in that endeavor. That is when I felt, oh, aha, that was my aha moment, saying that, okay, I can convince people to come and on board with me and start doing these transactions with other people's money, not only with my own money. If the product is right, then there are people who are willing to join in that journey. That was the big mindset change for me. Um, Other than that, I would say partners are key in this business, and it's not a single person sport. So you need to have right partners in multifamily or any commercial real estate endeavor. So that is a very key. So that is another aha moment that in a negative way, I did not do a thorough research in my initial transactions. Now I'm slowly started screening more stringently for future deals. I'm very picky with the partners to do the deal transaction. So just to make sure whoever is starting this journey and don't rush into partnerships without knowing the other person, without knowing their priorities, without knowing their focus or objectives in commercial real estate space.
Love it. I like the last message especially. Don't rush into partnerships. Look for the right guys. People think about it. People say this all the time. This guy's exactly like me, and we're gonna rock this together. Sometimes in a partnership, having somebody exactly the opposite of you is the perfect thing. You're the networker, you're the capital raiser, you know how to have the relationships with the brokers, and the other guy is the underwriting geek. You know what I mean? He
Yep.
knows how to underwrite and pick up every single last period and comma and pick up on it. So definitely important. Joel, last but not least, maybe share some aha moment and some newbie advice.
Yeah, so as far as the advice I would offer, what I had in mind was really echoing what Sridhar and you, Isaac, have just talked about, which is don't limit yourself to what you can do by yourself. Be willing and able and prepared to partner up. And that really will help you go further faster. Think about what sort of value you can bring to a partnership and what sort of value a partner can bring to you. Maybe you're, a whiz at spreadsheets and you need to be the underwriter, or maybe you love developing relationships and you're going to go be the guy who finds the deals or works with the brokers and or the owners to figure out a way to structure a deal that works for everybody. So think about, what you're good at, what you're passionate about, what you enjoy doing, and then find folks you can work with who who like to do the things that you find very difficult or kind of heavy work. So that's I think the key piece of advice that I would offer. And for me, the aha moment was when I figured out that piece of advice was valid. I initially started out doing deals that I could do by myself. I'd bring all of the down payment. I'd do all the due diligence myself. I'd work directly with the brokers. I'd do all the underwriting, and that got me a little ways into the business, but it really limited me in terms of what kinds of deals I could do and how many deals I could do and what sorts of asset classes I could get into. So as I figured out the world of syndication and the world of partnerships, that really changed my trajectory and enabled me to do things that I wouldn't have been able to do otherwise. So I think my first partnership, my first probably LP deal, was the one that really opened my eyes to that whole world and that concept of partner up and don't go it alone.
Love it. That's the idea of syndication as well. Syndication is you bring in other guys and you can scale much faster. People want to do stuff on their own. It's harder to scale. You don't have as much industry knowledge and relationships and investors. So all very, very important and great points. I like what Shane said. One of the points was go deep, deep, deep. Give that knockout punch. Something we talked about in the last show was this idea of having like 10 different markets. Now, don't get me wrong. People have a few markets. I know, Shane, you're in New Hampshire and Texas, but people that have like 10 different markets, it's the same idea. Go deep, deep, deep. Instead of just like here or there, know your market, know the knockout punch, know exactly everything. Guys, thank you so much. Unbelievable knowledge shared today. I'm really, really excited for the listeners. You guys really shared a ton of knowledge, a lot of industry, inside scoop stuff, and it's very, very exciting. I do want to end off over here and thank the sponsors one more time, something I do at the beginning of the show, the end of the show, Michael Stern of Line Star Tax and Elite Roofing. And guys, you heard it yourself. To all the listeners, you heard Joel, you heard Shane, you heard Sridhar. These guys are industry experts. Get in touch with them in terms of investing with them. I don't know if they take on new investors, but I'm sure they're open to the idea. Definitely people that have done a lot and have a track record. I don't have to sell them. You can just check them up yourself and you'll see that for yourself. So thank you so much for tuning in. See you on episode 3. Hey, everybody. Thank you so much for tuning in to the Stage Debate Podcast, the only podcast that is panel style. Drop a like, follow us, and subscribe to see all future episodes. I'm just as excited as you are. Let's go.